Hi, it's Anthony here. I hope you're having an awesome day. What we're going to have a look at with this video is what's called the TGIF trading model, commonly known as Thank God It's Friday. We're going to have a look at how market structure shapes up, how price is manipulated, and most of all, how to enter this trade at the end of the week. Okay, so with that, let's get into the video and enjoy. Okay, traders, it's Anthony here. So we're going to jump into something that you might find really interesting. This is the TGIF, Thank God It's Friday model. This is a model designed specifically for the end of the week to catch a retracement at the end of the week on Friday. Let's break it down. So what if you could anticipate and trade this move at the end of the week with a high degree of precision? This is not about guessing. It's about understanding a pattern that's engineered into the market and repeats itself week after week. So the goal here is to find a consistent high probability setup just for Fridays. And it's a setup that most traders completely miss. Okay, so here's the game plan. We're going to look at the weekly profile. Number 2, institutional logic. 3, the objective and timing. Number 4, 3-step setup. 5, managing the trade. And 6, key takeaways. What you're getting here in the video is the full blueprint A to Z. So first up, what you need to understand is that price action that you see every week is not random, not at all. It's following a script, an engineered profile that smart money uses to move price around. This idea is the absolute bedrock of the TGIF model, and that engineered profile has a name called the Power of 3, or just PO3. I want you to think of this as the algorithm's playbook. It's the standard operating procedure for just about any time period, whether we're talking about a day, a week, or even a month. It breaks everything down into these 3 things: accumulation, manipulation, and distribution. Okay, let's have a look at the story of a weekly candle. It's awesome. First, you've got accumulation. This is where the market is consolidating and building up orders. Then, bam, you get manipulation. This is a fake out move. This is also referred to a liquidity run or a stop hunt. Now, early on in the week, this is what sets the high or the low of the week. Okay, after this, we get distribution, which is the real explosive move. And finally, and this is the part we're zooming in on, you get the retracement on Friday. Understand that this is no accident. This is a logical end to the weekly program. So now you understand what's happening. Let's look into why, because if you don't understand why, you can't trade this with confidence. So the real question is, why does price reverse on a Friday afternoon? Okay, so let's just put this into perspective. Okay, this is a week looking at the Aussie paired with the US dollar. You can see here, this is where the market opened. It sets the high of the week, the run on liquidity, trades to the low of the week, and then we get this end of the week retrace, and that's what we're looking at in this video, to the close. This quote you see here is everything. This is a core smart money concept. Think about this. Big money can't just click a buy button for $1 billion position. It doesn't work that way. They need liquidity. So if they want to buy, they have to force price down to hit sell stops, to hit sell side liquidity. If they want to sell, they have to run price up to take out buy-side liquidity. Here are all the reasons laid out. See, Friday's reversal isn't just one thing. It's a multi-tool for smart money. First up, it's end of the week profit taking. They're also repricing the market for next week. The bottom line is they're deliberately targeting stop losses. They're targeting the liquidity. This traps traders into the close. It's totally calculated. Okay, let's get into the nitty-gritty. We know the why, so let's now define our mission. What are we trying to catch, and when do we pull the trigger? And here it is. This is the key. Our main goal is to catch 20 to 30% of a retracement into the previous weekly range. Now for a bit of perspective here. Open, high, low, and we're looking for that 20 to 30% back into the weekly range. Now, this isn't just a random number I pulled out of a hat. This is an algorithmic sweet spot. More often than not, price is drawn to this level every Friday, almost like a magnet. So the way to actually understand this is we're just basically trading the weekly candle's wick. That candle wick signature of profit taking, that's our target. Okay, so key Friday time for the TGIF is really 2 to 3 p.m. EST, although it can quite often occur earlier than that. Okay, so let's get into the setup. So just you understand, this is a specific setup. It's a mechanical process that we can follow week after week. And the key to this is if the conditions aren't there, we don't take the trade. It's that simple. Okay, here they are. There are 3 non-negotiable steps. Okay, here we are. Step 1, you need to confirm a higher time frame level. Has price hit a key higher time frame level, i.e. a monthly fair value gap, a previous high or low? This needs to be determined. Now, step 2, the lower time frame shift. We need to see that market is starting to break structure on the lower time frame after the higher time frame level has been hit. And step 3, precision entry. Execute on a retracement into a fair value gap or a breaker block. I'll show you that. Okay, here we are, 4-hour chart. I've marked up the weekly range. This is the area that we're interested in. First thing, higher time frame. Let's just scroll back and confirm that there's an important level left, and we've got exactly that. So it's trading into a significant support zone. Let's go down to the 30-minute chart and I'll show you how to get involved with this. And again, just to refresh your memory, you got the weekly open, the high, the run down to the low, and what we're looking for is this opportunity into the close. Now remember I talked about accumulation and distribution. This here is an accumulation range. It ranges, then we get the manipulation, that's the run on, these stops, and into a previous support zone. Everything is meeting our checklist. So when we see this setting up as such, especially this price action like this is how we enter the trade. Now we talked about fair value gaps and breaker blocks. There's no breaker block here as such, but let's just keep this really simple. All you need to see is the range, the run-on stops, and most important, after this point here, you want this rotation. When it trades off with speed and you see a thin candle with nothing left and right, and here as well, that's your cue. That's a bullish imbalance right there. Imbalance as in there's a green candle with nothing left and right, and what we get is the move back down into the imbalance. This is your cue to enter the trade, especially when you see this high being taken out. That's your entry point. Now I'm going to simplify this for you as well, but let's just start with this. Long position, stop loss under that previous candle, that's pretty tight, and well, there's 3-4 hour target. Stop loss under the previous candle low here, given that this is your entry. Okay, so that's one way to get involved with this. Another way to get involved with this is with the use of a couple of indicators. This one in particular. This one changes the colors of the candles. Let's go to a bar chart and I'll show you this. Now you can see it. See how the candle changed color right at this point here where that dot is? Alright, well that is your cue to take this trade. And that gets you in a little bit earlier, right down in here. And that increases that to about 5R. And you can actually set this dot as an alert to go off. That's the dot that I'm talking about right there. You can set that up as an alert in the alerts log, so you can just wait for that to go off on your phone. It's called the trend bars indicator, and if you go in here you can enable bar color, green and red. It'll give you green and red dots, but you use this when you have a trade idea, a trade plan, and you're looking for that next signal to enter. I like the colors. Now here's another thing. You can use these, see these green lines? These are bullish divergence lines. And this red line forming here is a bearish divergence. You can use that as a cue to exit at that point. All right, and it gets even more interesting if we incorporate, this is called the HTF momentum sync indicator, and I want to show you this. See this green shade here, green shade following price? Right there is your stop loss level. Tighten that right up. I'll just quickly show you the settings. If that's too tight, well, you could go 2 times the average true range. This is the average true range for the stop loss. And what this is doing is giving you confirmation that on the 1 hour, 2 hour and 4 hour charts, you've got buyers starting to step in and dominating the market. So right at this point where that up triangle fires, it's actually right next to the green bar dot. That's your entry, and your stop loss, if you're setting it 2 times the average true range, is exactly there. So just go a little bit wider with your stop loss on that. That might be a little bit tight. So you could pull it down to here, and that's a 3R outcome. So yeah, I mean, it saves you having to figure out imbalances and breaker blocks and all these kind of things. You just take that trade, and that gives you the Friday pullback into the close. So let's head back to the PowerPoint to just confirm a few important points. Okay, this is a really important slide. Sometimes there's no setup. If it's not showing up, stay out. If it's NFP week, you don't see a clean setup, just stay out of the markets. Okay, the key takeaways. Here is your TGIF checklist. Number 1, identify the higher time frame draw. Number 2, wait for that PM session. 2 to 3 PM EST is your window of opportunity. Confirm the lower time frame shift. Number 3, manage your risk, set your target, and enter on the model. The main thing is to use the indicators and take the trade on the momentum sync alert. Okay, so there you have it. That's the blueprint for the TGIF model. It's a model that pulls together time, price, and institutional logic into one powerful and repeatable setup. So as final note, I would say to you, backtest this thoroughly and understand the principle and practice. With that, have a great day, and I'll see you in the next one.